Welcome. This is the fourth podcast, and we're going to look at the US weekly indexes. So, it was unquestionably a really incredible week. We saw weakness on Monday. We saw an attempt at a rally on Tuesday, which completely fell to pieces. And there was a real weakness into the Tuesday close. And, even I thought, well, okay, maybe we're going to hit the 1950s after all. And of course, Wednesday we open up pretty high, and despite Yellen spooking the market Wednesday afternoon, we held strong gains and built gains into the Wednesday close. So we have one hell of a strong floor now, S&P 1972, and we've swung 105 points higher, which is, truly amazing. But anyway, let's go through the six indexes, and let's start with the S&P. So we do have a concrete floor now, 1972. We have a Friday high of 2077, which itself is only 2 points from the recent high of 2079. And, unquestionably, we're going into the 2100s. And the only issue now is, where do we get stuck? 2130, 2150, high 2100s, or even the 2200s, which I see a few people are starting to allude to. Personally, I think somewhere at least 2025, 2050 by late January, early February. Then, of course, the issue will be, what sort of retrace we're going to get. But I don't think it's going to be much more than 3-4%. Just consider, for instance, that the recent retrace was around, 105 points, which was about 5.3%. But you can see, having fallen 5.3%, we've already had a net weekly gain of 3.4% across just 3 days. So it continues to be a weird market, in that rather than a step up and an elevator down, it's more of a elevator up and a step down. It truly is an absolutely twisted, weird market. So S&P is headed for the 2100s, but there is now a really high threat that we're just going to keep pushing right into the spring to around 2300s or so. I suppose even 2400 is possible if the market goes really crazy by late April, early May. Now, typically, of course, we would get a pullback in May, June, and then off we run again. I'm really resigned to the fact that 2015 will almost certainly be like 2013, except rather than the Fed doing QE, you're going to have the Bank of Japan and other central banks buying, plus there's other numerous reasons. But anyway, moving on to the NASDAQ. So, interesting gain, 2.4%. And we're well on the way to the March 2000 high of 51.32. I see some comments out that people are saying, okay, look, we're going to get stuck at that level and then form a double top and then pull back. No. If you consider the other indexes, NASDAQ might get stuck in the low 2000s and chop around for a little bit, but more likely than not, we're just going to hit that level and just push higher. Maybe we'll go to, say, 5,500 or even 6,000 sometime next year, and then pull back, and maybe even back test the old level around 5,100 or so. I'm really more broadly looking for the 7,000s or higher by early 2016, which of course is a long way up. That would work out at roughly 40-45% or so. So, hell of a gain. And then clearly, if you look at the weekly chart, you can see that the current trend is actually starting to accelerate. Right, Index 3, the Dow, which, I think the 17K threshold was the key issue this week. So we came pretty damn close to breaking 17,000, and I gotta say, Tuesday evening when the market sold off into the close and the Dow was around 17,067, I was seriously thinking FOMC upset the market and we close Wednesday under 17K. That was going to be a real big problem. But of course we didn't, and so once again we have the Dow having a really strong support around 17,000. I'm resigned to the 18,000s in the very near term, whether that's before the end of the year or in January, doesn't matter. Clearly 18,000s are coming, and then the only issue is what happens when we get to the next kind of resistance zone around 18 and a quarter to 18,500. Of course, that's possible. 18 and a half could be in early mid February. And if you assume that we're going to be in the 18,000s, then, well, why can't we be at 20,000 by the late spring? In terms of the fib levels, the next fib level is around 18.9, and after that it's 26k, which of course is just, that's crazy talk. And that would equate to around S&P 3000. But anyway, good week for the Dow, on its way up like everything else. Next up, NYSE Composite. So the master index gained pretty powerful 3.7% this week, and I gotta say, I didn't think we were going to close in the 11,000s to end the year, but now it actually looks very possible. Next key upside target is clearly the 11.3s, where the upper Bollinger is on the monthly, or is that actually the weekly charts. And there's a reasonable chance it will get stuck around there, but that's just it. If we start seeing a weekly or monthly close in the 11.4s or 11.5s, it's like, okay, we're actually in an accelerated trend. That's gonna be a real issue next year. Index 5, the Russell. Now this is the really big index to be mindful of. So the Russell was the market leader this week with a massive gain of 3.8%, closing around I think it was 1195. Now, so we're only about 18 points shy of the summer high of 1213, and once we do break above 1220, then there really isn't anything to stop this the broader market going up. And then you've got to be looking at the Russell in the 1300s, if not eventually 1500 sometime next year. Okay, so final index, transports. Now, clearly, I think it's pretty safe to say that the transports is suffering because oil prices are starting to level out and build gains. And when we saw an oil price gain on Friday of roughly, I think it's somewhere around 5.5 to 6%, and that's got to hold the transports back as long as oil keeps going up. And if we see oil in the 70s, which is my bounce target for somewhere between March, April, and May, then the transports is going to be held back. That doesn't mean, of course, the transports can't keep going up. I'm certainly looking for 10,000 on the transports to be hit by the spring, but it will be almost certainly the laggy index for the coming quarter or two. Okay, so in summary, we have a really strong floor of S&P 1972. We have even got some spike floor candles on a lot of individual stocks or sector ETFs. It's a strong market. We're headed much higher. Now, of course, there's issues of, I think the two big issues are, one, oil prices, and two, interest rate policy by the Fed. In terms of oil prices, as I was just noting, I think we have floored at $53.60. We had a micro floor on Tuesday and then a secondary floor on Thursday. I think that's a really powerful issue that not many people at all are paying any attention to. I mean, I think it's a pretty simple upside target of below 70s by late spring, early summer, and then I'm looking for a renewed downside, because the problem is for the oil producers, OPEC next meeting isn't until June, and if oil prices are in the 70s or even kind of close to 80, they're not going to cut production, right? Many of them will be pretty content with, say, anything around 70, 75, certainly 80. So they're not going to cut production. When the market realizes that, we're probably going to see another significant down wave in oil, probably taking out the $53 low from this week, and we'll lose maybe the $50 threshold in the probably late summer, early autumn of next year. But the bigger issue is that oil prices are going to remain relatively low, and that is extremely bullish for every sector of not only the US but world economy. Of course, the energy sector isn't going to be doing well, and I realize that there are implications to that. But the energy sector is just one part of the economy. The rest of the economy is a hell of a lot more important. And contrary to what some of the maniacs, not least those on Zero Hedge, are saying, low prices are a good thing. They're a good thing for just about everyone. Everybody has to travel, everybody has to buy things, and everything in the modern world is linked to oil. So low oil prices is bullish. In terms of the secondary factor of interest rate policy, now listen to the Yellen on the Wednesday. She was kind of alluding that, don't worry about the next couple of Fed meetings in terms of interest rates. So I think there would be a Fed meeting in January, and then the next one's March. So I think she was basically alluding to no interest rate rise until probably either April or May, maybe as late as June. Now, personally, I still think there's a chance that there'll be a rate rise of 25 basis points at the March FOMC. But that, of course, is going to need to see GDP Q1 come in at least above 3.5%, plus to see net monthly job gains of around 275 to 325,000. That certainly seems possible. I mean, those are not bold targets considering, the broader economy right now. And for you regular readers or listeners now, you should be aware that, I mean, I haven't really covered it in depth, but higher interest rates are bullish, contrary to what many would say. There's all sorts of reasons for this, but suffice to say, the economy should be able to cope with official Fed rates of 2 to 3% within the next, 2 years or so. And then maybe the Fed will start cutting rates as the next recession hits, which of course it will at some point. So as for next week, it's going to be a short week, of course, basically a 3.5-day week. Low trading volume favors the old algo upside melt, so VIX will probably decline across most of next week into the Friday close. That's going to help the bulls. We could even see 2100s next week. And any retraces, are going to be very minor and very brief, and they'll be bought up because the power of the rally from Wednesday morning is so strong with it. It's got to mean that the market is going to have to keep pushing higher for the foreseeable future, at least into mid to late January, which easily is going to get us into the 2100s, maybe even 2200s by early February. Interesting week. Next week will be quiet. Of course, the following week's a full day week as well. Okay, I want to just thank everyone who's messaged me this week. It's always appreciated and always good to hear from some of you out there because, you wonder if you're just writing or talking to yourself at times, even though I see people, on the map pinging away. So keep an eye on oil. I think that's the big issue for the equity market right now. Ironically, higher oil prices are going to inspire the market even higher. Interesting week ahead. So I should say a good night from London, and I'll be back.